Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
Well, 2 Timothy 1:7 says, "For God has not given us a spirit of fear and timidity, but of power, love, and self-discipline." Hi, folks. I'm Certified Kingdom Advisor Mark Trice, and I want to welcome you to the Spend Life Well show, where we apply biblical wisdom to your financial life. I'm joined, as always, in the studio today by my co-host and fellow financial professional, Jesse Hamilton.
Hello, listeners. Welcome to the show.
You know, Jesse, that verse in 2 Timothy reminds me of some of the questions we get from listeners during an election year. On today's program, we're going to break down the facts and dispel some of the myths about elections and their impact on financial markets and your savings and investments.
Great.
But you can give us a call anytime with your questions. We love to talk to listeners. 254-282-0495. You can also text us at that number. Send us a text. We'll answer your question on the show. If not, we'll get back with you within a couple of days and make sure you get your questions or concerns addressed. Jesse,
thanks,
folks
Mark.
can also email us, can't they?
Yeah, they can send us an email at radio@spendlifewell.com, radio@spendlifewell.com. We'll try to respond to you within 24 hours of the show. And if your question's really good, maybe we'll even talk about it on the show. And just go ahead and reach us out via email or the phone number 254-282-0495.
Send us a text. So we love to chat back and forth with listeners. If you get a lot of good information out of this show, let us know. We like to know somebody's listening out there. We know people are. Maybe you just don't think about it, but we could use an attaboy every once in a while as well. So especially Jesse. Jesse needs attaboys every once in a while.
Yep.
Well, so Jesse, it's been a kind of a data-filled week again. The market's been selling off again.
Yep, it has.
We closed below those June lows, and now we're talking about the September lows, and we'll get into that in our market update. But, it's that time of year, or really the time every 2 years or so, that we get lots of questions from listeners about the elections and concern and fear. And that's why we chose 2 Timothy today, because, God's not given us that spirit of fear, but of power, love, and self-discipline. And we want to remind people that, God's got everything in control. But let's talk a little bit, see if we can break down what typically happens in years that there are midterm elections, and what does that mean for the markets? There's really, we talked about 4 things that we came up with that we think you should know about midterm elections and the markets.
Right. So we we have several points to make here. Not that we're able to predict what's going to happen in the upcoming months, because it's going to be volatile regardless. But our first discussion point is that the stock market usually dips before a midterm election. So whether you're looking at the Dow Jones or the S&P 500, some of the major indexes in the United States, we expect volatility, and historically there's been a dip.
That's pretty normal, right? In midterm election years, and we've already had a pretty rough year in the stock market, right?
Right.
We've been in and out of bear markets. I heard a term for that I'd never heard before today, and that it was the NASDAQ, and NASDAQ has entered into its second bear market, which I didn't even know was possible. Right. I guess you can kind of start to come out of a bear market and then you go down again. But that means that the NASDAQ, after having a little bit of a rally in July and through the first part of August, has actually climbed and fallen over 20% since its mid-August mini peak. It wasn't the peak, but it was a temporary peak.
Well,
so,
Mark, we're going to get into this throughout this entire segment, but what we're getting at is people don't like uncertainty, whether that's, it has nothing to do with your political affiliations, which way you lean, which way you vote. People do not like uncertainty, and we can see that in the markets.
Yeah, and that's the big thing here. with that. I mean, what was we did some research, and basically on average, the S&P 500 declines by 19% or more in the months before a midterm.
Wow.
And there's lots of reasons why the markets rise and fall and stuff like that. And of course, we know what's going on this year. If you've listened to our show ever, you know we've been talking about the stress over inflation, the Federal Reserve's response to inflation. But Jesse, you nailed it on the head, and that is investors and thus the markets, if you will, don't like it when things are unknown. They don't like the
Right.
uncertainty.
Yeah, there hasn't
So,
been an episode this year, I don't think, where we have not talked about either inflation or the Federal Reserve.
and we're
So
going to talk about more of it today
we're going to
later in
talk
the later
about it
segment.
today.
So don't worry, folks. We'll bring it up again.
Hmm.
But the point there is not to cause worry or anything. It's just that all that uncertainty creates volatility in the market.
Hmm.
So, a lot of folks come to us, Jesse, and they got all these questions like, this. You think about this. Think about if the market were a human being, what questions might the market want to know, right? Which party will control Congress come November?
Yep.
What new legislation can we expect? How will the results affect our taxes, our healthcare, and our budget? Oh, lions and tigers and bear, oh my. And we get worked up about it, and you're going to hear lots of pundits on the television or the radio making their predictions.
Right.
But Jesse and I have never found a crystal ball that actually works, right?
Yeah, we're still looking for it. We haven't found it.
And Jesse, I don't know, when you were a kid, did you have one of those magic 8 balls?
I'm envisioning those snow globes, but no, I did not have a
You
magic
didn't have a
8 ball.
magic 8 ball? Okay, I'm going to go find you a magic 8 ball, because you can ask the magic 8 ball
A
certain
lot of
questions, and it
questions.
will shake it up, and it'll give you the answers, right? And that's what people want. The only reality is we know that the magic 8 ball is just a toy, right?
Hmm.
It's not going to give you, with any type of predictability or reliability, the correct answer.
And
And
what people don't want to hear is that the pundits on TV don't know either.
that's why they make money, because no one
Yeah.
ever comes back to say, "Hey, was that guy right, or was that lady what she was talking about? Did that come out that way?" They don't care.
Hmm.
Uh, in fact, some of them are so predictable. There's actually been some securities that have been developed, and we won't tell you what they are or anything, that actually do the opposite of what a particular financial pundit wants to put out there. We're not going to tell you who it is or anything like that, but it's just kind of funny that these folks get paid to make these predictions, and a lot of
Hmm.
times, and they're smart people. I don't want to say they're dumb or stupid or anything, but they don't know either.
Right.
They don't know either. So the
Well, the
only
other
fact that we know, the only thing we know is true, Jesse, is that no one knows what the future will bring until the future becomes the present, right?
exactly true. And I heard somebody the other day say that they're allergic to uncertainty, and I really liked that phrase.
Yeah, the markets could be said the same way.
Hmm.
It's that uncertainty or that allergy is like the driving force behind many market pullbacks.
Yeah.
And you normally have this little bit of uncertainty before midterms. That's why a lot of times historically you naturally have a little pullback in the months up ahead of a midterm election. So it's not surprising that, but add on inflation and rising interest rates and things of that nature, international turmoil in Ukraine
Hmm.
and other places.
Right.
It's not surprising the markets are going to struggle.
Sure.
But there's good
Well,
news, right?
there is statistical good news here. We can't predict the future, like you said, but the data shows that after the fall comes the bounce.
Yeah. Historically, markets enjoy a major rally in the third term of a presidential term. Okay,
Third
so
year of it.
presidential for 4 years, the third year of that president's term, typically, historically, not always, but historically, has produced a pretty good climb. What's the average, Jesse?
So the average is actually 32%. I don't want anybody to get that number in their head, as that's going to happen next year. But
Somebody's driving down Mopac right now, or 183, and they're quoting you and writing that down. Hopefully, they're not writing and driving at the same time. But no, that is not something that will happen every year. But that's just kind of the average that we've seen in the 12 months after a midterm election.
Right. But it really does make sense because there's a lot of questions that are answered and people feel more secure after that election. So the uncertainty begins to fade away.
Yeah, right. So you have a better idea. We know who holds the cards. So just as that uncertainty will drag down the market before an election, the resolution, right? When we kind of figure out how things might go, that often pushes the markets back up. Of course, we have to give a very important caveat that we've alluded to here on the program today. Past performance does not indicate future results. So past performance does not guarantee future results. I
Like all
tried
the
to say it as
commercials.
fast as I tried to say it as fast as the FedEx Man commercial, but I think that one came out before you were born, Jesse.
Well, there's a certain fund, and I won't say the ticker of it, but you see it all over the sports channels these days. We saw it all over March Madness last year. And right there, the first thing at the bottom of the last page, past performance doesn't indicate future results.
Meaning that what we did last year does not in any way remotely mean that we're going to have that return this year. In fact, a lot of the financial companies that we've seen, Jesse, that are putting out a lot of material to say, hey, you don't want to miss out on the best days in the market, only are going through the end of 2021. They're not incorporating this year's data. And you'll see that. And, financial companies tried to massage the data that tells the best story about their particular investment that they're offering to you. So even though, that past performance does not guarantee future results, a little bit of market wisdom is always true, and it's especially worth remembering now.
Even more than that, a little bit of encouragement can always help people's sentiment of their portfolios, because people are scared right now. It goes back to that verse in 2 Timothy.
Exactly. And we got a little bit more here because the financial news has been starting to use the R word. The R word. So if you've got children in the car, you probably don't want them to hear this right now, but it's the threat of recession. The threat of recession. If we had sound effects on our program, Jesse, this is where we'd have someone scream.
I hope you just made some little 8-year-old say the word recession thinking they were saying a bad word.
So there is the threat of recession going into 2023. Now, I think, Jesse, here we got a lot of data coming out this week and next, and in the third week of October, we'll actually get the economic growth or decline numbers, the GDP numbers. Right now, most pundits, and if you ever want to look and you want to know what the forecast is that particular week, most pundits are saying about a 2.9% third quarter annualized growth in gross domestic product. You can just Google GDP now if you're looking for some material for your Halloween party or upcoming barbecue. You can get some little factoids, and you can be the Cliff Clavin of your party and throw that out there. But who knows? We won't know until the data is actually released. If that is true, we have positive economic growth, which I wouldn't be surprised if we do for the third quarter. If that's true, then we're technically not in a recession, because the technical definition of recession is 2 consecutive quarters of negative economic growth. We had that in the first and second quarter, although no one will admit it. But the Fed is looking for a slowdown, and we haven't seen that yet. The Fed's been trying to really balance, do this high wire act, if you will, across Niagara Falls of, trying to bring down inflation without bringing down the economy.
And they really have to be careful what they say, because these days investors will take the slightest intonations and make a decision based off of it. But
it's crazy sometimes what the investors think they hear. I mean, if Chairman Powell coughs, they're out buying cough syrup stocks. I mean, it's just crazy. We don't recommend cough syrup stocks. We don't recommend any securities on this program. It's not that type of program. But it's incredibly difficult for the Federal Reserve to navigate this situation where we have high inflation. The tool that they have available to them is to raise interest rates, and you could do too much too fast. That can really hurt the economy. You don't do enough, that can only accelerate inflation. So we have to be careful of that. And
Notice how you
unfortunately, those
said
efforts have been really the effects have been really minimal so far.
I noticed how you said tool, not tools. Not like they have this plethora of toolbox things that they can go and do. They basically have a toolbox, and all that's in it is a hammer.
Yeah, I mean it's very limited, and it's we could have a whole show on monetary policy and the Federal Reserve, but yeah, so they got a tool, a couple of tools really. They do have a
Yeah.
hammer and a bigger hammer uh, they can use. But what this means, it probably means that we're going to have more interest rate hikes in the future. Probably a couple more by the end of the year, and then maybe one or two next year. But it's going to depend on how the Fed sees the economic data that come in. Last week we had the jobs report come out. It was a little bit stronger than expected. Markets didn't like that. Today we'll talk about producer price indexes and the cost of producing those goods. It was a little higher than expected. These are not data points that the Fed wants to see.
Mm-hmm.
The Fed wants to see that those inputs decline. So, Jesse, there is evidence. I mean, we know that the market's going to react if we officially go into a recession, because it's going to affect corporate earnings and different things like that. We're in the middle of the third quarter corporate earnings report season. Some have come out and disappointed and met or missed expectations. Some have exceeded expectations.
Mm-hmm.
That's a whole nother topic of conversation. So, history has shown that markets sometimes don't do well after a midterm election whenever there's slow economic growth mixed with high inflation and rising energy costs. And this was the case that we saw back in the late 1960s and 1970s. And it's just very similar to the sort of stew that our country finds itself in right now. Okay?
Mm-hmm.
But on the other hand, even a recession, either whether it be real or imagined, because I think it's real, the White House says it's imagined, it doesn't mean that 2023 will be a bad year for stocks. The markets really, one of the things we know about the markets is they move more on the expectation of future events than really what's happening right now. So, Jesse, when people see that inflation is still hot, the market interprets it as, the Fed's gonna have to raise interest rates even more or continue it for longer than expected.
Right.
It's not really necessarily reacting and saying, "Oh, inflation right now is bad." It's just about future expectations. So,
Right.
what should we really be thinking about, as we wind down 2022? I know we still got a few months to go. What should we really be thinking about there? Do you
But
think
it
the
doesn't.
markets have priced in that recession already?
They might have. There's really no way to know, but it doesn't. Our point here is it doesn't really matter who wins this election, right?
Right. That's the point we want you to take away here, listeners. And we need to take a break, Jesse.
Okay.
And hopefully our producer won't get mad at us for skipping that. We'll be right back. You've been listening to the Spin Life Well Show. Okay, welcome back, everyone. You've been listening to the Spin Life Well Show with your hosts, Mark Trice and Jesse Hamilton. We've been talking about midterm elections and the markets and what can we control, what don't we have control over. We got excited in the last segment, and we actually made it run a little bit longer. Our engineer let us know that, hey, we need to take a commercial break. That's part of doing radio. Sometimes you just don't look at the clock and forget about that. But, our verse today that we've been thinking about is 2 Timothy 1:7. For God has not given us a spirit of fear and timidity, but of power, love, and self-discipline. Well, there may be, if you listen to the news, there may be things that cause you concern.
Right.
And the midterm elections can be one of those things. We get questions all the time from listeners that are concerns like, oh, should I not do anything until we figure out who it is? And, in reality, the markets don't care who wins in November.
Right. So, that could be whether you're a passionate Republican or a devoted Democrat, or maybe you're somewhere in between.
Are we going to get into politics here, Jesse?
No, we are not a politics show, and sometimes we have to rein it back because we are definitely not a politics show.
We have opinions too.
We definitely have opinions.
Know that, right?
Yes, I have my personal opinions and decisions that I've made to vote different ways and stuff. But
I think, Jesse, what you're saying is that the markets are not nearly as partisan as people are.
Right. And nobody thinks like that because it's ingrained in the way that we think that you're one or the other. And the market is so much more than that because the people involved in it are both sides.
Yeah. And folks, you're going to hear lots of opinions about what that's going to do. The markets don't care. All right. The markets don't care. And, as we've said, history shows that in some years it rises higher than others, and markets tend to rise after an election, no matter which party's in power.
Mm-hmm.
And
I think
what's the reason for that, you think?
Well, politics certainly play a role, but the markets are affected by so many more things.
Yes.
And believe it or not, Washington is not the top of that list. Despite
I lived up there for years, Jesse.
Yeah, I did know that.
And believe me, the good folks up there, I still have many friends up there, so I'm not talking about my friends. Washington in general as an institution thinks that the world revolves around them. That's why they built a beltway around the city, so it could circulate,
drive around and look at it.
Yeah. and you're right. Washington is not at the top of the list of things that affect the markets. They do influence them, but what are the things that really impact the markets?
Well, it's these things that we talk about almost every week on the show. Supply and demand, corporate earnings, interest rates, inflation, housing prices. There's tons of them.
Yeah.
That are higher up on the list than Washington.
Employment, all these things. And so it's true though, Jesse, that the government does have an influence on many of those things, but the government doesn't dictate the daily rhythm of the markets.
Right. Well,
you gave me a good analogy earlier about, markets and our bodies.
Mm-hmm.
Why don't you share with listeners what you were saying there?
Well, our health is determined by what we eat and how much we exercise and sleep, hygiene, things like that. But there are things we can't control, like our genes and maybe the place that we live and maybe some of the part of our lifestyle that we can't control. But in this case, the politics are to the markets what brushing your teeth is to your overall health.
Right, kids, we're telling you right now, you should make sure that you're brushing your teeth twice a day, if not 3 times a day after every meal. I have to remind my kids every day, did you brush your teeth? And sometimes they'll tell me yes, and it's like, no, you didn't. There's no way you could have in that last 10 seconds. But yeah,
it's not life or death.
Hygiene, right?
Yeah, it's not brushing your teeth is probably not going to kill you, but it is important.
It'll impact your health over time, but it's not going to kill you. Right. So as we mentioned earlier, though, Jesse, the S&P usually rises after an election, and that's been true over history, not every year, but regardless of which party is in the White House or controls Congress. So where the things get a little bit interesting is whether the government is united or not.
Right, and this makes a lot of sense to me.
Okay, talk about it.
People working together can get a lot more accomplished.
Right.
But polls suggest that Republicans are favored to take the House.
Okay.
While Democrats will keep the Senate. That's just
and that changes every day. Those polls are updated all the time, depending on which institution or polling group is doing the things. As of this broadcast, that's the latest that we've seen.
Right, but think about the gridlock there. If one house controls the House and the other controls the Senate.
Which is kind of the way it is right now, because you've got a tie. Well, although Democrats can break any tie, but if you have an opposite party in one chamber over the other, then that's going to potentially cause things to slow down. And so, gridlock, hey, we don't like it. We want our stuff get done. We want our opinions to be implemented. So it's not really fun for us as citizens,
Hmm.
but the markets tend to take that in stride. And that's because gridlock usually means maintaining the status quo in terms of economic policy.
Right.
And the status quo is something that investors know how to handle.
Hmm.
So what if one party wins both chambers of Congress?
You could make an argument why that the markets might go up a lot because of the efficiency in the political machine.
Okay. So for example, what if the Republicans take control?
Well, it's unlikely we'll see any new tax changes or regulations that could affect corporate earnings.
Okay. What about if the Democrats get both chambers?
There's a stronger chance of more types of stimulus, or
Yeah.
a lot of people have grown to rely on that in the recent years.
Yeah, and the markets really have too. But what's the one thing that's causing high inflation right now? All that stimulus that we put out there in the last few years,
Yeah.
and I'm not giving my political opinion here, but we don't need more of it,
Hmm.
and that could possibly happen if the Democrats retain control of both chambers.
Right.
But the point here is that history shows that markets are as politically unbiased as you can get in the country, and that's important, Jesse, because that's kind of how our founding fathers, our founding fathers really intended. They wanted things in the new government that they created in 1776. They wanted things to change slowly.
Hmm.
They didn't want gut reactions and drastic policy changes. They designed it that way. And in today's political and economic environment, little change or no change is good for financial markets.
Yes, but
So this
it's
brings us to the fourth and final thing we want to know about the upcoming midterms. All right. Never make investment decisions based on politics. Now, this is a
hmm
problem. A lot of people have a problem with this because they know if ABC candidate gets in office, the world is going to heck in a handbasket.
right.
Or they know if XYZ candidate gets in office, everything will be perfect in the world. It doesn't matter, folks. I don't care if you wear a red baseball cap or a blue baseball cap. You should never make financial decisions based on politics. And this is especially true when it comes to your investments.
Right.
How
I
many folks have we heard that, they call us up, they're concerned, should I
well,
put my money in the mattress? Because if Joe Biden stays in office, Jesus may be coming back. Well, that could be a good thing, right? But if Donald Trump stays in office, the world's coming into an end. So I think that you have to be careful about that. You
yeah. Wait,
need. Go ahead. I'm sorry, Jez. I mean to interrupt you. I know you're about to say
no, no,
something.
no. I'm just saying we're not saying if this person is hypothetical or real. Either one is potential, but yes, some individuals would like to say, "I am not putting my money in the market until so and so is gone, or until so and so is back,"
Yeah,
and
and
that is
you
such a
make that decision. Yeah, it's
it's such a
poor
poor
investment
decision.
decision. That's the opposite of having an investment strategy. What do we call that, Jesse? When you don't have an investment strategy, but you put your money or do something with your money based on intuition.
Being scared. I don't know. What do you call
It's
it?
speculation, right?
Speculation.
Speculation. We
Hmm.
saw this a lot in the Second Gulf War. Second Gulf War, we saw a number of people ask us questions about the currency in Iraq, and I think it's the dinar. I'm not really for sure, but they were convinced that because America was there, that it was just going to go up in value. And you immediately understand that that person didn't understand how global currencies work and all that stuff.
Right. They're not doing
And
price contracts.
yeah, it wasn't, but they thought it was an investment strategy. No, that's the opposite because you're basically speculating
Hmm.
that that's going to go up, and you don't
Right.
want to make your investments based on speculation. You have to have a strategy, and that should be independent of who's in office.
Right. And we hate to bring individual names into it here, but like who maybe missed the longest bull market in a long time because they disliked Obama, or
Oh yeah, I heard
maybe
that all the
somebody,
time.
yeah, maybe somebody missed the quote Trump bump or whatever you want to call it, the bull market during Trump's presidency because they disliked him. I mean,
I remember. Now this is kind of true because I was watching in 16, Jesse. I was in 2016. I was watching election night returns. My wife goes to bed. I stay up and watch them because I'm a political junkie.
mhm,
And there were people that were crying on this particular channel because it looked like Trump was going to win.
mhm,
And the reporter, and I can't remember her name, she's no longer reporting because it was such a disaster of a presentation. The futures market for the Dow was plummeting about 700-800 points overnight. I mean,
mhm,
this is at one
which is
o'clock in the
huge.
mornings. So,
Yeah.
but it doesn't really mean anything. It's just overnight stuff. And she cried because my 401k, I'll never be able to retire. Oh, how could this happen? And so a lot of people decided that they were just going to park their money. Same thing with Obama. They decided they're just going to park their money.
Mhm.
And yeah, it's true that midterm elections, both before and after, do impact the market somewhat. But what that doesn't mean is that we should change or abandon our strategy. And
But
make no mistake, Jesse. This is an important time of year. It's a time when we, the people, get to decide the direction of our country, or state, or our local communities. But it's not the time for changing direction towards your financial goals.
right. I think that's something we can all agree on and push here is to go participate, go vote,
Go
express
vote.
express your opinion. That's the way it's supposed to work.
Now, if you're concerned about your portfolio, you can give us a call at 254-282-0495. You can send us your question. We'll try to answer it. One thing that we can guarantee, Jesse, we're not supposed to say the word guarantee, but we
Yeah,
think that
that's a bad word here.
it's a little bit easier to get in touch with us than maybe your congressman. So
Mhm.
uh, we want to respond, and we'll respond as quickly as we can to your question or concern. But I wanna reiterate, Jesse, that verse because I think a lot of people live in fear about their financial future or the
Mhm.
economic future and so forth. 2 Timothy 1:7 says, "For God has not given us a spirit of fear and timidity." We don't need to be afraid, but of power, love, and self-discipline.
Mhm.
Folks, like we said, Jesse said, and I've said, it does not matter what's going on in Washington. God's got a plan. God cares for every little hair on your head.
Mhm.
He's going to provide for you, and you need to keep moving forward with good biblical wisdom about your finances. Consult a good Christian financial advisor to help you along that journey, and everything will be fine. Most important thing right now, Jesse, is what? People need to go out and vote.
And vote, participate.
Yeah. In Texas, I think early voting starts October 24th.
Mhm.
And of course, elections are on, I think, the 4th or something like that. So, folks, we're going to take a quick break. And when we get back, we're going to talk a little bit about stuff that's in the news, give you a market update. You've been listening to the Spend Life Well show. We'll be right back.
All right, welcome back to the Spend Life Well show. I'm Jesse Hamilton, and I'm joined as always by Mark Trice, Certified Kingdom Advisor. We've been talking about politics and the upcoming midterm elections, but I wanted to remind everybody of 2 Timothy 1:7. For God has not given us a spirit of fear and timidity, but of love, power, and self-discipline. So let's dive into our next segment here. What are we talking about, Mark?
Well, there's a lot of economic data, and we always talk about inflation, or at least we have in the last several months on this show.
Mm-hmm.
And producer price index came out today, where wholesale prices, these are the inputs into manufacturing, and production's wholesale prices rose more than expected. And so these are U.S. supplier prices increased more than projected in September. And that really reflects that these inflationary pressures have persisted and aren't necessarily slowing down just yet.
Right. So this
So
is upstream production on the goods that we buy and use every day, whether it's devices or all the way down to our food. These U.S. supply prices really do have an effect on Americans' lives.
that's right. That's right. And so um, on a month-to-month basis, the consensus forecast was that this would go up 0.3%. It was actually month over month from through September was 0.4%. Now, year over year, these producer price index moved up 8.5%. That's versus that they were expecting 8.1.
Mhm.
So, stock markets didn't like that early in the morning. I think things have kind of calmed down a little bit. Later this week, we're going to see those measures of the consumer price index, and most pundits are thinking that that will continue on up. We're expecting a rise of about another 0.4%
Mhm.
in September. You annualize that, and that changes things quite a bit. On an annualized rate, that comes out to be about 4.8% year over year. I think we'll probably see that up 6.5%.
Right.
But some economists in a Bloomberg survey expect that number will be not 6.5%, but probably 6.6. So even hotter inflation. But I think the thing that people are expecting is that rise of 0.4% gets back to those rates that we haven't seen since really early in 1982. So over
Wow.
40 years
Yeah, that's been a long
since we saw
time.
that too high.
Yes, it has.
So the overall the thing you got to listen for here, folks, and when we hear those numbers this week is, you know, the White House will come out and say that inflation decelerated, and it's going to decelerate, yes, but to like 8.1%. 2 months ago it was 9. This is still really a really fast pace. And the reason that the year over year numbers have declined is because we've seen gasoline prices over the summer months actually decline. Now they're starting to go up now.
Mhm.
Jesse, I don't know if you filled up your tank here in the last week or two, but what was 2.89 is now $3.20
Yeah, it's
when I
slightly
filled it up the
higher.
other day. Yeah. So and that should continue to rise because we're going into the winter months, and
Mm,
producers change their formulas. It costs more to produce that type of gasoline in the wintertime. So
right.
you're going to see those prices go up.
Well, we talked, was it 2 weeks ago, about rental inflation?
Hmm.
A lot of people see that as a really important leading indicator. And one professional that we study said that he doesn't expect to see a speedy return to lower numbers because of that persistent rental inflation.
Yeah, in fact, one of the Fed governors, I think it was Christopher Waller, reinforced that. He gave a speech this last week that said he's closely watching that inflation and the cost of shelter.
Hmm.
And he went on to say that unfortunately, the message is that shelter inflation will likely remain high for several months. This is one of those things that usually the shelter inflation is a leading indicator. We start seeing that start to fall, that could be an indication that inflation has peaked. So the thing, folks, that I think, Jesse, that folks are really feeling is just what's the inflation of food?
Hmm.
I mean, that's what impacts us every week. We can choose to drive less, but we still have to eat every day.
Right. And
And I
that's
think people
that's
are still
whether
seeing that increase.
you're going to the grocery store and eating beans and rice every meal, or you're going to eat out every meal. Either way, you're still seeing over 6% inflation in food. Some restaurants, it'd be interesting to do a study, or to maybe, if anybody out there listening owns a small restaurant, could give us input on how much have you had to raise your prices just to make the same money as last year.
Yeah. Uh, my family, we don't eat out as much anymore
Hmm.
because it can easily cost us. what might have been, $50 or $60 for a family of 6. Now I can't. It's hard for me to get out of a typical restaurant, like our favorite Mexican food restaurant for less than $100.
Wow.
It was like, no. And so, you mentioned beans and rice, and it's like, hey, that's a regular staple rotation in our household,
Yeah.
because costs are going up. Jesse, I think people are really, we'll have to watch that data as it comes out. My advice to folks here that are our listeners is, don't make too much of the numbers this month.
Hmm.
What we're really looking for is the trend, and we have to see a few more months of falling inflation before we say, hey, inflation has peaked. And so we'll just have to watch that as it goes along.
So you're saying that you can't look at one number in isolation.
No, you can't, especially when it comes to a very slow moving economy. Think about this as trying to turn a giant aircraft carrier. It's not the same as driving a ski boat, right? Where
Nope.
you can zig and zag. That aircraft carrier takes a lot of time to turn that ship. And so the economy is very similar. Things have to be gradual. That's why the Federal Reserve is trying to be gradual in its interest rate hikes, because they don't want to cause the ship to capsize.
Right.
But don't look at one number, look at the series of numbers, and it will begin to be good news if we, in November, we see October inflation started to subside a little bit. It has to, because if we keep having rising inflation, that what that means is that inflation is out of control. We got hyperinflation. So we want it to pause. We want it to slow down a little bit. But still, until we get down to the Federal Reserve's target of 2% inflation, we got a long ways to go. And we've got to see a lot of things change in our economy before we see that. So, Jesse, let's give a quick market update of what's been happening this last week. Let's focus on the year-to-date numbers of some of the major indices that we follow.
So we're still in bear territory here, Mark. The S&P 500 is where we're going to start. That's 500 large cap companies, the largest companies in the United States that are publicly traded. That S&P 500 index minus 24.7% year to date.
Yeah, that's quite significant. And I'm
It
sure
really is.
as people are opening up their 401k statements and their quarterly statements from their investment accounts, you're going to be surprised. And if your advisor has not talked to you about that, or if you don't have an advisor, please come give us a call. We give complimentary consultations and the second opinion or portfolio. There may be some easy things that you can do to protect your wealth, and you can do them yourself. You don't even have to engage us, but give us a call. You can call us at 254-282-0495. That's 254-282-0495, or visit us on the web at spendlifewell.com. So the S&P way down. What about the NASDAQ?
So the NASDAQ's even further down, 33.36%. That's all of our huge tech companies that we've all heard of, our devices that we love so much. But
that's
they're
almost as much as the bear market, mini bear market we had in the pandemic.
Yeah, it is. It's approaching that level, and this index tends to be pretty volatile. But you might also own some small caps. So the Russell 2000 index minus 24.6%.
Okay, so kind of similar to the S&P 500.
Yeah.
Okay. All right.
In
Now
theory,
that's usually when we see that start to turn around. That usually means that we've got a breadth to a rally, and the markets are turning around. But we've seen that really decline rapidly in the last 30 days. I think it's down quite a bit, but I think in the last month, it's the Russell 2000 is down about 11.5% in the last 30 days.
It is. But we always like to talk about bonds because the typical portfolio is going to hold some bonds, and this year they're hurting. So the 20-year Treasury bond index is down 32.6%.
That's the safe place, right?
32%, Mark.
It's worse. It's worse than the S&P.
Yeah.
Bonds are supposed to be safe, and I can't say that word. I predict that a number of you have a significant portion of your portfolio in some type of bond index or corporate bond index. Folks, open up your statements. Take a look. Give us a call. go to our website, request a meeting. It's complimentary. We'll give you that second opinion, and we will help you navigate this very volatile market. We'll give you some suggestions. You can do them yourself. If you just, throw up your hand and say, I can't do this anymore, we'll help you. Okay? Don't ignore it. This is not the thing to ignore. This is not like the old adage where everything comes back. This is the first time that we've seen these indexes decline more than double digits. I'm talking about the S&P and the aggregate bond index. This is the first time we've seen this happen since 1931. This is a serious event. And we're seeing that, and we're seeing a lot of similarities to the great financial crisis in 08 and 09. I don't know where the bottom is. No one does. And so you need to take preventative steps to protect your portfolio and do something about it.
Mhm.
Now, Jesse, I gave you the list of the New York FANGs, the Facebook, Amazon, Netflix, and Google. Those were the darlings of
Of the
the
pandemic.
post-pandemic, right?
Right.
And what are those? What is that index down year to date?
Well, we haven't seen this yet, but it's actually 40%. It just ticked over 40
40% in the negative
in the negative.
year to date. Okay,
Yes.
folks. Hey, we've given you that's our report, and we should have a little teleticker going in the background.
Yeah.
Newswire going off, and we've given you the facts. Now it's up to you to take control of your investments and do something about it. Talk to your financial advisor. If you don't have one, give us a call. Don't let your 401ks sit idle over there. You've got to take action and do some things to make sure that you're in charge of your money, not the markets.
Right.
Okay. So, Jesse, do we have any questions from our loyal listeners?
Well, we have several actually, and
Okay.
one of them ties especially well into what we just talked about. And of course, this person probably wants us to predict the future, which we can't.
Hold on. Let me pull out my crystal ball.
But the question is, do you expect to see a similar year next year in the bond market?
After careful consideration and pondering and consulting the oracle at Delphi, just teasing folks, we don't know. Now, does that mean because the bond markets have sold off so quickly, because of rising interest rates and things of that nature, do we expect there be a little bit of a rally sometime? Sure, once they stop raising interest rates and once they start lowering them. But the Federal Reserve has pushed that timeline back so many times. It may be 2024 or 2025 before we see the Fed pivot on its interest rate policy for that. You've got another problem too. The Fed is selling bonds off their balance sheet. That's creating an imbalance in the supply and demand of bonds.
Yep.
So I do think that bonds will rebound at some point. I just don't think it's going to be anytime soon. So next year, maybe. That's why we focus as financial advisors to focus on the data that's involved. Our clients right now, we don't own any bonds. Okay, I think I can say that because that's a fact. But our advisory clients do not own any bonds right now. So we are very concerned about bonds. And as Jesse just reported, minus 32% in the long-term treasury. Okay, that's impacting portfolios if you own them. So just be careful. Don't bet on what you think is the future, because we go back to our conversation about the elections and things. If you're doing it based on certain things that you think will happen, you really are speculating. You need to respond to what the data is telling you for pricing in the markets.
Yeah. Well, I think we spurred somebody's thought earlier during the election section.
Yeah.
Because we had this question. It says, "What about things like the Inflation Reduction Act, which was
Which
that
doesn't
big
actually lower inflation?" Okay,
right
go
that
ahead.
big bill that passed about a month ago." So that had to do with funding green energy and restricting different publicly traded companies and whatnot. Lots of different details that didn't really change inflation. But the question is, what would you say? Would you say that's an example of political agendas affecting the markets?
Well, yeah, sure. I'll give you that one, because once that bill was in play and was being discussed, we saw a number of green energy companies rise up a little bit. solar, wind, whatever it may be, battery companies, stuff like that. But it didn't play out,
Hmm.
and that's because the investors realize that it may take years, decades, for these investments to really have an impact on those companies.
Right.
So yeah, the talk influenced the markets a little bit, but it didn't last. So,
Right.
Jesse, we're coming up on the end of the program. I know there's other questions out there, folks. If you send us a question, we will get back to you. You can always send us a text anytime at 254-282-0495. Lord willing, we'll be back with you next week. We pray that you have a blessed weekend and a blessed following week. And folks, you've been listening to the Spend Life Well Show. We thank you for tuning in. We will see you next week. Have a great weekend.